All right, everybody. Thank you for coming here on Saturday. Thanks for having me. And let's spend the next hour or so together. I guess since I'm the last one, if we go a little extra, that's okay. So, put your questions out there. I don't mind questions as I'm presenting. If it's something that I'm going to get to, I'll let you know, and we'll get to it at the end. So let's get going here. I'll tell you a little bit about myself and my history, and then we'll get right to it here. I started out, excuse me, probably like a lot of you. I think most of us, I think, do start out that way, knowing nothing about the markets or a little bit, but we want to make money. And, back in the late 1980s, I didn't know a darn thing, but I wanted to make money. I thought, how do you trade stocks? And I started educating myself, which I found out is the expensive way, but there wasn't any of the education. Well, I shouldn't say any of it, but, it came snail mail. There was no internet. It was very difficult to find out how to do this and learn about technicals and such. So what little bit was out there, I tried to figure out on my own. Took quite a long time and went through, the process of, the software and different indicators and so on and so forth. In 1994, I created a company called Pristine Trading and started educating. And I've educated probably tens of thousands over the years. I've done live trading challenges, hedge fund managers, market makers, prop traders. So many in the industry have come to getting that education. A well-known prop firm paid me for my old education content because they wanted to present it to whoever they could present it to, and of course the prop traders there. A lot of my students have become educators as well within the industry, and they teach what they learn. So I've been doing this for a long time. Many have learned what I taught myself many years ago and put together in a systematic method way of interpreting price patterns. And I do this today through Master Trader, and I call it Master Trader Technical Strategies. That's myself today. I do a lot of videos on YouTube, which you can go to the channel there, YouTube/C/Master Trader. Myself and my partner, we do a lot of short videos, some a little longer. You get a lot of education there for free and see what we do. This is me almost 20 years ago. Maybe it's almost 20 years ago, and was at the first Traders Expo. And that's the booth. That's me in the middle there. It was Pristine Day Trader, talking about training, and technology. And I went to the Traders Expos for many years. I did the trading challenges there. And, they were great back in the day. And a lot of the, let's say, the big boys in the industry, the brokerage firms that control those expos today, back in 1999, were telling everybody, don't go near those day traders. You're going to lose all your money. And today they're enticing you to come there and open up accounts. You can't turn on CNBC without seeing a commercial. So times change. Technology changed in a big way. Of course, when I started out, as I said, there was no internet. I was downloading over a 2400 baud modem to get end-of-day data and using a satellite to get some real-time data that stopped working when it got cloudy. So it's been a long time, and I've seen a lot of changes in this industry over the years. Some more free education. If you come to the site, the chart of the week, we put out videos, commentary, analysis about the markets, different lessons that you can learn from there. So, we educate. We're an educational firm, and through these various free services, you can get to know us and decide if you want to continue with that education. Now, this isn't something that was available back in the day when I first started. It eventually evolved, but that isn't to say that I didn't use things that look something like this. I think this type of indicator has become possibly the ultimate out there that tries to do everything possible to defining trends, entry points, turning points, so on and so forth. But I mean, I went through the whole process of, you know, the Fibonacci and the not so much Elliott wave, but I can remember back in the day how far out into the twilight zone I was hand drawing a half-hour closing chart of the Dow, where I'd gotten the data from Barron's each weekend, and drawing that out on graph paper and projecting it into the future as to time cycles. And you know, it got kind of crazy, you know, even to the point of calculating, you know, whether it was a full moon or a new moon. And sometimes it worked, but eventually I got to the point where I said to myself, you know, what happens when it gets there? Do I bet the house waiting for that setup? And I then eventually just removed everything from the chart because, you know, it got to be indecisive, just too many indicators and too many squiggly lines. And by removing that, the light bulb moments started to come on. And what I found was looking at basic foundational concepts where it originally first started. And it was like, price is king. Everything else is secondary. All we need is a price chart to look at the trend and support and resistance and patterns. And sure, we can look at, you know, whether something is showing relative strength and relative weakness. And there are details and nuances to increasing the odds of a trade. I mean, everything comes down to that price information on the chart. No matter how you want to massage it through different types of indicators, it's there for you to see. And what I found and what I teach is how to see it without all of the lines or confusion, as it was to me, was confusion. And I think everybody gravitates toward those type of indicators thinking that it's going to eliminate the confusion. But what you need to do is recognize that, look, when the chart doesn't make sense, you just don't trade. You stay away from it. You can't trade every possible movement in the markets. And part of the difficulty in trading, if you will, is sitting on your hands and waiting for your setup, because it isn't like any other job where, you know, you're completing a task and you're getting some gratification of accomplishment, possibly even in the moment, whereas you might sit in front of your trading computer for several hours and do nothing and wait. And that's part of the discipline. And then, you know, forcing yourself to pay attention so when the opportunity comes, it doesn't pass you by. So I look at, you know, that price information in the candlestick format. Why? Because it just makes the pictures pop out versus the bars. But you could trade the bars by themselves as well. Trend analysis. How do we define the trend? Well, it's simply, is it making higher highs and higher lows, you know, or going sideways, or lower highs and lower lows? It's that simple. Multiple time frames is probably the biggest thing that you can put to your advantage, and that's a big part of what I'm going to talk about today, because when those trends are aligned in your favor, the odds are overwhelming that you're going to get a successful trade if you enter at the proper time and then have position and money management to go along with that. Now, support and resistance, that's a big factor as to where my entry is going to be and the probability of a bigger move and prices trending, which I'm going to show you. Volume. It's a secondary piece of information because in the moment you are the volume, but to recognize the volume in the past can be helpful. Do I absolutely need it? No. Take the volume off the chart, I'm still going to know what to do. Position and money management is big. You can be the greatest technician, you can have the best technical tools and fast internet speed. If you don't have position and money management and know how to do that, the odds are against you. You can make money here and there, but consistent money and, you know, exploiting a position is essential, especially to money management. And this is what I teach, Master Trader Technical Strategies, and it's applicable to anything. When I say stocks, option, futures, forex, options have their own educational content to learn how to use them and such. But as far as price patterns go, it really doesn't matter what you trade at all, whether it's Apple Computer, whether it's oil, whether it's whatever it might be, because it's you and I that trade these instruments, and it's about recognizing those patterns that are a reflection of what everybody is doing, and that's supply and demand and their expectations. So there's no best market. It's what's trending and where the money is flowing into for longs and out of for shorts. Your job is to recognize what that is and not fight it, meaning you might have done great trading, whether it's oil or just E-minis or whatever it might be, and then all of a sudden some indecision comes into that market or that stock. We have a lot of traders that I've worked with that just trade one or two stocks, and that's fine. But sometimes they stop trending, and it's difficult to trade them because they're whippy and erratic. I say it is what it is. Now let's talk about candlesticks a little bit. There's so many different names. There's a lot of different patterns. And everything I do is to try and boil it down to common sense and make it simple. So when I look at candles, I say, well, is it a big candle or is it a little candle? Did the range expand or did it contract? And when they're contracting, that means momentum is slowing down, as well as if the candle body, right, these candle bodies here, when they're small, momentum is slowing down, or is it shifting? When you get a big range candle after smaller ones, it's igniting a move if it's a large green one. And if it's a big red one, it's igniting a move to the downside. Now, the other side of this is when you've got prices trending in one direction and then you get a big green candle. That's signaling the end of a move or the beginning of a correction, whether that's sideways or a pullback. What that candle is telling us in the moment is that traders, investors, hedge fund managers are now throwing caution to the wind. And they're chasing, and everybody says, "Oh, don't chase because you're in a bad position or entry point at that point." Well, where's your stop going to be? If you chase, probably not where you're going to want it to be because prices have been trending for a while. And if you've chased, you probably haven't calculated your share sizing, and you're going to get chopped up. So when you recognize or see a big candle after multiple candles moving up and prices trending, you're closer to a pullback than you are a continuation. Right? Whether it's a slight pullback, like what's happened in this market currently, where those that have chased and they're still chasing are actually getting paid. It's going to stop at some point. And I remember this very well in 1999, where chasing paid. I saw traders buying stocks that were gapping up, $15, $20 on earnings report, and they went up another $20. So markets do get a bit crazy, and eventually they begin to correct. Now, when you see a topping tail bar, it could have been a big green bar, and a bottoming tail bar could have been a big red bar. So there's been a sizable retracement. When we say buyers took control with bottoming tail bars, and sellers took control when we see topping tail bars. And we want to keep this really simple. So there are 4 foundational patterns that I look for. And it says, don't get caught up in exactness. A lot of traders, they recognize a pattern, they learn a pattern, and they need to see just that because that's what their eyes have been trained to do. The markets typically don't give us what we want exactly the way we want it. Sometimes, but not as much as we'd like. So we have to be flexible and recognize these patterns in a broader sense, and then put together the pieces that I'm going to explain to you as it occurs. So this is just your normal type of retracement pattern in an uptrend, back down towards some support or sell setup in a downtrend. Now we also get retest patterns, which is one of my favorites. because it gives a little bit more time. As you know, as time goes by, by definition, time is going by, and you're getting that retest, and it's building up a larger area of support there. If it's got a bottoming tail pattern and it's retesting that, that's even a higher probability pattern. Now, if prices are extended and to the upside and prices are pulling back, I need to have a retest pattern. That's one of my rules, because that is what I call creating a support area. The majority of times we're going to be looking to buy this type of pattern on a pullback to some area of price support, where there's been some consolidation over to the left and where there's some resistance over to the left for our sell setups. If we've got a momentum type of a move to the upside, I look for these retest patterns. They are higher probabilities. Flag patterns often happen after the beginning of a move. So this is another way of creating support in an uptrend. So when prices come out of a consolidation, many times they won't pull back like the one on the left, because buyers are in control and there's a lot of demand, and you get what's called a flag type of a pattern. So what that means is prices kind of inch their way down slowly to the downside, and then they continue to move up again. I like to see bottoming tails in that type of a pattern, because it's what I would call a minor shock, where prices have dipped down and they spring right back up again. And it tells me that there are strong bids and buyers under the market. And the odds are that prices will continue to move up after that. It's the type of signal bar that I like to see within this type of a flag. And then there's, of course, just the base. When I say well-developed base, you need multiple bars going to the left, and that might be 8 bars. It could be 10 bars. You have to really look at the pattern that preceded it. And this is where, looking at price patterns and training your eye and looking at many charts tell you when it's time to act. One of the tools that I use is a simple 20-period moving average, whereas prices going sideways into that moving average is a way of me using a visual aid to determine when prices are likely to move up again. But looking at these individual bars are going to communicate to me when it's time to act, whether they either break out to the upside or they break down to the downside. Now, this concept that I call a void, this was one of my light bulb moments years ago as I looked at hundreds and hundreds of different charts. And, as I understood the price patterns, the next step in my learning process was to determine the difference between those trades that chopped around and really didn't do much of anything or stopped me out versus the ones that did really well and trended. So my light bulb moment was, well, if there's no reference point for other traders or institutions to offer out at, in this case I'm going to say offer out because we've got a bottoming pattern here, odds are prices were going to trend, because prices move between these reference points that we call support and resistance. And if prices are moving up, let's say for an example, it's a new all-time high, there's nothing there. Where are you going to sell? Most of us will use a prior high as a reference point to offer out at and sell what we're long, and vice versa. So if there's nothing there, where are you going to offer out? It becomes a guessing game to an extent, or where certain traders might use fib extensions, which putting a line in a chart up in the middle of nowhere, I guess it provides some sense of what to place a trade, but we can just do that with just price, with trade management, whether it's bar by bar or using pivots, which are swing lows within an uptrend. We have trade management. So this void is created by rapid price movement. It could be a gap, which we're going to talk about, or just a fast movement like we have here on the left side of the chart. Now, when prices move down that fast, what we call a climactic type of a move, the memory of that move down is fresh, and you've got a lot of losing traders holding on to those losses where they tried to get in on the way down. So they're going to sell on a push up. Normal. They want to get their money back if they can. But as prices move sideways over time, they move away from those areas that are there, if there are any, and the traders that are holding losses have a tendency to exit on these little dips to the downside as prices try and move down. If you look at that blue arrow there right in the middle, that little bottoming tail bar that blips down to a new low, that's a great setup indication of a kind of a flushing move to the downside to get traders to sell. And then as prices move back up, continue to go sideways, that little shakeout is one of the things that I look for entry points for counter trend trades. Now, that little area, I got a little red area marked out right over here. And then to the right of that, you see what I have marked as bullish price action. So there was that little gap up. It's at the beginning of a day. And those candles there that whip back and forth turn out to be a consolidation. At that point, we really don't know which way it might go, but the probability is that it's going to go up because it's already extended to the downside and going sideways. So as it's gone sideways with that little red box to the left there, it's what I call absorbing supply. In other words, buyers are stepping up where there are sellers, and that's where the prior high is, that's where there's sellers, and they're taking it in, and I look at these individual candles, and the first one that's got the tail on the top and the bottom, it's like, boy, that's really whipsawing back and forth. Nobody really knows what's going on there, but people are trading and trying to make sense of what it is. And then the second one, you get that green candle that's trading inside of that range. So things begin to tighten up. And then you've got the bottoming tail candle with the small candle body there. So the momentum is slowing down and there's more certainty coming in. So when I look at charts and I look at price patterns, as I said, I'm looking at what other traders are doing. What are they thinking? What are their expectations? And it's clear to me at that point that the sellers are beginning to lose control. The question is, can the buyers take full control and move it up into the price void? So once it starts to move up, that's the trigger to get in. After that, you're in management mode to see what's going to happen. That's the unknown. So you have to have a method for managing. For me, it's looking at what I call bar by bar analysis and as prices pivot. But in this example, it moved straight up, so it did exactly what I was hoping it would do. And I've got little to no reason to sell. As it begins to move up and close the void, the odds become greater that prices are going to begin to pull back. So closing that void in this case is going all the way back up to where it started from. And I don't know if you can see my pointer here or whether I need to get the pointer out so you can see it. I don't know if you can see my arrow. But at that high there, let's just say just above 1,300, the momentum begins to slow down. And how I determine that is by looking at the distance between those high points. So the prior high where there was a red candle, there was a large move up. And then the second move up was much smaller before the momentum began to stall. And that's one of my ways of looking at momentum slowing without indicators, whereas an indicator type of trader would look at this and say, oh, the indicator made a lower high, so there's a bearish divergence, or however they're going to look at that. I just look at the price action. I can see the momentum is slowing down, and the next question I ask myself is why? And I answer that by looking to the left. And if it's in an area of price resistance, well, that's my answer. There are sellers here. And at that point, the next question is, does it reverse the trend? And we go into management mode and multiple time frames to say, well, what's the probability of that happening? So let's talk about using moving averages in a useful way to determine where prices are trending or the direction that prices are trending in multiple time frames. Now, one of the things I learned, and I thought was that moving averages are not support and resistance. I thought they were because that's what I read at the time. They can become a self-fulfilling prophecy, meaning, look, anything that enough people are using as a reference point, whether it's real or not, they're going to act on it. And they can make it a reference point, a 200-period moving average on the daily chart of the S&P 500 or the 50. Traders are going to act at that point because they've been doing it forever and they've been taught to do it. So is it real? Well, for me, I look at that and say, I look to the left and say, is that in alignment with any area of price support or resistance? Because I've seen countless times where prices just ripped right through that 50 MA or 200 MA, or how many times you've heard, even on CNBC, prices went down through the 200 MA. We're in a bear market. Right? A week later, it's up above the 200 MA. What happened to the bear market? And we're back up, moving up again. Seems lately the 200 moving average may never be seen again. Of course it will, but this market has defied any type of normal pullback. Drawing trend lines up and down. Just look to the left. You don't need to draw trend lines. Is it making higher highs and higher lows? Trend lines were another tool that I found to be subjective and misleading. Break of a trend line doesn't violate the trend. Only the break of a prior low does, because it's no longer making higher highs and higher lows. Moving averages help speed up the analysis. I can do without it, but it becomes a visual aid. The same thing as a candlestick. We can look at a bar chart with the open and close on it, but I look at the candlestick chart and I just see what I want to see a lot faster. So the 20 MA is a relatively short moving average, and it follows the trend well. As I said, we define that trend by swing highs and swing lows. Now, would you agree that these time frames are trending in the same direction? If you look at it, you got a 60-minute chart on the upper right, you got a 15-minute chart on the lower left, and a 5-minute chart on the lower right. And it's not a trick question. As we look at that, and it's the S&P, which has been trending up, and we say, well, of course, it's trending higher. Can't you see that, Greg? they're all going up. So the next question is, would you agree that the odds are on the long side? And the point I'm making here is that when you have multiple time frames moving in the same direction, the odds are in our favor, in this case on the long side, because they're all moving up. And so I'm looking to show you a way of using these moving averages so that we can look at one time frame and make our trading decisions. One of the hurdles that we all have is looking at too much information. And the more information we look at, the more we need to process to make a decision. So if I can make it easier to make a trading decision where I know the odds are in my favor, why not do it? So we look at another example. Would you agree that all three are trending in the same direction? So as we look at this clearly, well, the 60 is trending up and it's beginning to pull back, but the 50 has turned lower, and clearly the 5-minute is trending down. So at this moment in time, we'd say, well, the odds are not in our favor to do anything. Based on the 60, that might change in the near future, but at this point in time, because they're not in agreement, we stand aside. Right? Simple. And so we would not say that they're all in agreement on the long side. So how do we look at this in one chart? That's the goal here. And we want to use it to see the trend and the location of those moving averages of one another in one time frame. And we can calculate that and look at it on one chart. And this is what a lot of indicators do. They may do it in different ways, but this is a really simple way to do it, where you look at an indicator or a scan that says, is this stock trending in multiple time frames in the same direction? And you have this wonderful indicator that you'll pay a lot of money for that'll tell you yes it is or no it isn't. Right? And we can do this with simple moving averages, and this is how it's done. So you just look at, and the same, we're looking at a weekly 10 MA is the same as a 50 MA. And it's simple to figure out. It's 5 bars for one weekly bar. So we take that 5 bars and multiply it by 10, and we get a 50 period moving average. We can do this with any moving averages and any time frames. So a 60 MA, right, using the 60 minute with the 20 MA is the same as a 240 on the 5 minute. 12 bars times 20, 240. Now, I want to keep things simple, so I'm just going to use the 200 period moving average because it's close enough. I'm not interested in the exact points because that's not how trading works. Right? You have to be flexible. Now, the 15 minute, right, the 20 MA is the same as a 60 period moving average. 3 bars times 20, 60 MA. Simple. And then on the 5 minute chart, I'm just going to put those 3 moving averages, and I'm going to look at the moving averages, and I'm going to say, are they going up together, are they going sideways, or are they going down together? And I'm going to know what's happening in all 3 time frames. So that's what we're going to do. 5 minute chart, I know the trend and the location of those moving averages in all of my time frames. So here's a chart of Tesla when it pulled back down toward 300. So I always start with the daily time frame. And in this case, we've got a climactic type of buy setup in an area of price support. You can see the little consolidation there over to the left. And there's the 5 minute chart with my 20 MA, my 60 MA, and my 200 MA. And I can see that prices are trending up. I know they're trending up in all 3 time frames. Because the 60 MA is the 20 MA on the 15-minute chart, and the 200 is close enough to the 240 on the 60. So there's your 15-minute chart, and I marked to put the arrow there so you can see where the 20 MA is, right? 323.81, and the 60 there is like, I don't know, the 20 there is on top of it, but 323, whatever it is. It's give or take a few pennies. It's right there, right? And in the start point, you can see the low down there on the daily and on the 15-minute as the reversal began to happen. And here's my 60-minute, which was basing. We had this momentum move down, right? Those are the 3 down bars on the daily time frame, and then the little downside shakeout where the star is, and then the consolidation. And then you'll see on the 60-minute chart the wide range bar. Notice the volume there. So you had a wide range bar igniting with what I call committed volume, which suggests prices are going to go up. And prices are consolidating on the 60, going sideways at the top of the wide range bar, which is creating a new support point. That's bullish price action. And you can see the same consolidation on the 15 and, of course, on the 5, which is suggesting that prices are going to break out or should break out, and they should continue to move higher. We know what Tesla did from there. The daily price pattern did not suggest it could make new highs, but it did suggest it could get up to 340, possibly 350. That's a good trade, you know, on a short-term basis. So what I'm looking for are these moving averages to be in alignment with each other. I'm not interested in the cross there. I'm interested when they're in alignment, meaning the 60 is the 60-minute trend is above the 15-minute trend, and so on, and they're aligned that way, and especially when they begin to track together. Now, the 60-minute trend of that 200 can be flattish, but we want that 20 and the 60 to be below and beginning to trend down. That tells me prices have to be trending down. They're moving in the same direction. The odds are in my favor. Is there a void below here? And then I just look for one of those foundational price patterns. So once they're moving together, right, and these moving averages begin to come together, it says the volatility is beginning to contract. It should expand in the direction of the trend and the price void. Remember, the void is defined as a lack of reference points of price support. So it should trend lower. There's no holy grail here. Just common sense, simple analysis, what I call MTS, or Master Trader Technical Strategies. I just wanted to show you an example of what we're not looking for. When you see moving averages intertwined with each other, going back and forth through the middle of prices, the message is screaming out loud, stay away. Sit on your hands, wait for things to change and come together, or trade something else. But don't bother with this picture because it's just too erratic and whippy. Why bother? Okay. So here I have a daily and weekly time frames coming together. I say, well, how do I know that? So I only have one time frame up here, and it's a daily, because that 50 MA is equal to a 10 MA on the weekly, and I can see that the green line, the 50, is flattened out, and it's beginning to roll over, and I can see the price pattern on the daily, what you might call a type of a head and shoulders top, which is just a distribution pattern where the head made up a new high and it failed to do so, and then in the retracement came up toward that head or resistance and then began to consolidate. In other words, it couldn't move back up. So now as it begins to break down and there's a void there, it should keep going down. So there's the daily on the left, and here's my 5-minute chart. So as I look at this daily pattern and I see a breakdown begin to happen, I then wait for the 5-minute chart to line up as explained, and then look for a pattern to set up where to act. And it's simple, it works, and then from there, you're in management mode. Here's another example. I say, before you trade the 5, you would have defined your bias on the daily time frame by what I've shown you. We look at the trend, support, resistance. Is there a void? Is there a price pattern there? And so at this point down here, while the moving averages are aligned, they're not rising yet. Now, would I have traded this right here? It's possible. And this type of pattern that you see at the beginning here, right where the number 13 is, that type of setup is one that typically does exactly that in the morning after the daily chart just began to ignite a move. And in other words, it's like a fake out move at the open, whereas prices gap down, but the daily chart is screaming buy. And it gaps down in the morning. Maybe it's created by HFTs, I have no idea, or somebody just throwing a big sell order out there. But they gap down and they bounce right back up again, and they do exactly what this chart did as it moved back up again. And then once it's aligned, we look for continuation patterns, which is the first little green box there. Notice the wide range bar at the top, and then the momentum stalls, but the trend isn't over yet. And as it pulls back and you come into lunch and you see 12 o'clock, things tend to get pretty choppy. And then later on in the day, as you come out of the doldrums, as we call them, that long rectangular green box is a retest pattern. Those prices retest the prior low. That's where traders are going to be bidding. There's going to be buyers there. And once you get that reversal pattern, that's your signal to buy. Now, a common question would be, well, what about the prior highs up there, Greg? Why would you buy at that purple line, right, the 15-minute trend there, and assume that it could go through those highs? Because of the bigger picture time frame analysis. When you have higher time frames pointing toward prices going higher, areas of resistance become less potent or powerful as such. Whereas, let's say prices were in a downtrend, that area of resistance, even if this 5-minute chart looks like this, are going to be more potent as a reference point. And multiple time frame alignment. Another example, right? Price is trending together. The 5-minute trend is up. The 15-minute trend is up. The 60-minute trend is up. Look to buy pullbacks to support. Look to buy continuation patterns. Why do prices trend like this at times? multiple time frame alignment. There's a void on the higher time frame. You've got multiple time frames in alignment with each other, and you look to buy pullbacks. You look for your entry points and continuation patterns to participate in the move. All right. So let's talk a little bit about gaps. Gaps, a lot of them revolve around shocks. So the guy on the right might be your typical fund manager holding XYZ, and for whatever reason in the morning, prices are gapping down. They looked fantastic. A big part of price patterns and understanding them is to kind of put yourself into the pattern. How would you feel? What would you do if you owned this stock where it was moving higher the day before, above 120, getting above the consolidation, closing up near the highs? You have to be like rubbing your hands together saying, man, this is fantastic. What a great trade. Glad I entered it when I did, yada, yada. And now it's gapping down under the low of that breakout bar. You got a problem, especially if you chased it and you bought near the end of the day on the green day. What are you going to do? Do you have any type of management for the disaster rules? You need to have those. How are you going to handle that? Now, this is what I look for. A gap under a wide range green bar. I'm just salivating at that to wait for the market to open and see how that trades. Is it in alignment with my 5-minute time frame, or when does it get into alignment, and when does it give me an entry point? Because the odds are it's going to go down. Now, from a gap trading perspective, I'm interested in it that day to make money. Not really interested in the next several days from the gap trader's perspective, but this type of pattern does suggest that it'll continue to go down. So I've got 7 criteria to look for. Now, is this setup bullish or bearish? Is it a professional gap? Is it a novice gap? So we're gonna rate these gaps, and we're gonna have an objective way of looking at these gaps and saying which ones have the greatest probability, because a lot of stocks gap every single day. I'll show you, the gap scans that I use. So I look at, is it gapping above or below support and resistance? Is it clearing it completely or not? Was there a shock? Like the example I just showed you. Did it break out or did it break down? Is it a continuation pattern? So the daily chart is our starting point for making our decisions and evaluating that. Is there support or resistance nearby, or is there a price void? Now, once it starts trading, and even before it starts trading, we can determine to some extent, is it showing relative strength or relative weakness to the broader market? Meaning, what if the market is gapping up? I know it does that every day now, but at some day it's going to gap down. Right? When it's gapping up and XYZ is gapping below the low of a green bar, that's showing relative weakness. That's a point in our favor. And if the market starts to trend down after it gaps up, well, that's going to put a little gas to the fire on that stock to push it lower. What's the size of the gap? Is it ideal? Is it acceptable? Or is it so big I just may as well scratch that? Now, when we look at gaps, I look at the percentage gap in the morning, and I start with a 1% gap. You might think a 5% gap is excessive. It's not. So part of size of gaps is visual, and you look at them and say, well, that one's in the stratosphere, or maybe it's a buyout. But a 5% gap or an 8% gap isn't a reason to scratch it off. A lot of them work. The greater percentage of stocks gapping in the direction of the gap go in the direction of the gap. If you're trading E-minis, it happens not so much today, but historically they tend to fade the gap. Stocks they go with. Now, all 7 of these criteria are not necessary to trade a gap. If they're all there, fantastic, but at least it gives us an objective way of measuring. Now, as I look at these examples, you look at these examples, and say, well, which ones were showing a shock? Well, clearly B, gapping under 2 bars. The prior bar was green. C, there's no shock there. D, yeah, that's a big shock, and that's a great one, especially if this was a base prior to the left of it and it's gapping underneath it, and so on. E, gapping above a red bar. F, no. And G, gapping above a base. If it's in an uptrend, well, obviously that's going to be a go with. So as I look at these examples, I look at my gap scan. Now I have to look at the chart and put the gap in perspective of the daily chart. So the one on the upper left is gapping above a red bar. It's gapping above resistance. I'm going to say that there's a void there. There's nothing to the left. I'm very interested in that to see how it's setting up, and do I get a pattern on my 5-minute chart. The lower left, well, it's gapping above a red bar, and it's slightly, the red body there. It's not gapping above resistance. I might be interested in that. It's not the ideal. The ideal would be for it to gap above the orange line. Just above the orange line would be perfect. Now the upper right, it's interesting. Well, it didn't clear all the resistance. It's right there. Now we need to look at the 5-minute chart. A bottoming tail bar, the first bar in the morning, buy it above the high of the bottoming tail bar. Look to the left. Is there a void? Is it showing relative strength? That's another point. And so we put all of these pieces together. Now the lower right is of no interest to me whatsoever. Although it's gapping up, it's gapping up into resistance. It's in a downtrend, even though it's going sideways there. I have no interest in that, so I don't even bother to look at it anymore. So this is the process that we go through. Right? So advanced gap strategies. We're combining the gap and technicals. We're putting the odds in our favor. We know the odds are in our favor when we get the pattern. And in this case, the lower left there, that bottoming tail bar, gives us the signal. And one of the criteria that I look for is there a base at the end of the day? In other words, the intraday chart, how is it structured? Was it going down at the end of the day? Was it going up at the end of the day? Was it going sideways? Now, ideally, gapping above a daily base and an intraday base, I know it's not extended, and now it is gapping up. I now have support under here. So that bottoming tail bar on the 5 tells me that there was strong demand when it dipped down there, and it sprung right back up again. You say, well, why did it spring back up? Well, because of the strong demand, and you have traders that are bidding in the gap fill in the base. You say, well, why don't we bid in the gap fill in the base? Well, that's not part of what I do. It's someone else's trade. It's not my trade. It might just keep going down. Anything can happen. I want a price pattern that confirms to me that those traders, those institutions have created enough demand to form a picture that I recognize and part of my plan to act on. And that's an ideal picture, that bottoming tail bar. And you even get a little consolidation to the left of it, which is near perfect. And then up we go. Now we're looking for these patterns over and over again. So when that last point here, the 2-minute, the bottoming tail bar signals long to get entry above it, you'd have a buy set up there on the 2-minute if you were right at the bottom of that bottoming tail bar if you use a 2-minute chart. Here's another example. Downtrend, retesting prior resistance, and a gap down. End of day base. Here you can see the base on the 15-minute. So this is an example just shorted under the 5-minute low. And the base is a big reason why I would do that versus, let's say this topping tail bar here on the daily chart, on the right side there? What if it was going down all afternoon? And then it gapped down, and the first 5-minute chart was a red candle down. Well, if it was already going down, let's say 8 5-minute bars, that's not a pattern that I enter on. That would be chasing on that time frame. So my entry point and my interpretation of my entries are applicable to the time frame that I trade from, because that's how I'm going to manage it. Now, is there a way to manage it and enter from there? Only based on proper money management, meaning I have to enter with smaller shares and a big stop. There could be reasons why I would do that. Obviously, it's another subject. But this is the ideal scenario because I can put a stop above that base, that 5-minute base there. Another example, and I love this one because now you get a retest pattern, whereas you get the break first thing in the morning. If you shorted it under the first 5-minute low, your stop has to go above the base there, so you have to share size it accordingly. But this example gives you another entry point on that little retest pattern on the 5 with the topping tail. And notice the breakout failure on the 5-minute at the end of the prior day. Right into the close, buyers took the breakout and got caught, and now it's going lower in the morning. The daily chart is in a downtrend. It's been basing. It's breaking down. The odds are that it's going to go lower. Overnight traders are caught. And as I said, as we look at charts, they're a reflection of what others did. Why did they buy the breakout? I don't know. I wouldn't do it. I just know that they're caught. And the daily says it's going to go lower. If there's a void below, enter your trade based on your pattern and manage it accordingly. Right. So here is an example from yesterday. Right. ABBV. Don't know the name. There's the symbol from yesterday. It gapped up in the morning. It was on the gap scan, right near the top of it. And you go through your list. Where is it gapping to? Was there a shock? Was it a breakout? Is there a void? Is it showing relative strength? What's the size of the gap? What's the intraday pattern? And we go through this process, and as you get used to doing it, you do it in seconds as you do this evaluation. And you see there's an end of day base. See the little mini shock that I've got marked there on the 5-minute chart, the beginning there? What occurred there was prices started to go down, and they broke the low of the day, and they sprung right back up again. Now, that's in alignment with my bias of prices going up. So that little mini shock in alignment with that, that's my signal to buy above the high of that bar. Some might buy above the high of the day, but for me, that's enough. That little shock, which kind of clears out the early traders that entered right in the morning, that trade real tight, that are trading off of the 1-minute or the 30-second chart or whatever it might be, they're getting out, and they're supposed to get out based on their time frame because it's breaking lower, unless they calculated for a bigger stop, of course. So that kind of removes the supply that would come in as those traders get stopped out. You get your next buy setup, which is a pullback into minor support, and then you're managing from there. Position and money management. How are you going to manage the trade once you're in it? You have to have rules for that. As it pulls back and forms a consolidation, and then moves up again, you raise your stop. The bullish price action. What that is telling me, right, as prices begin to pull back, we all get concerned. Am I going to give all of my money back? What's happening here? That's what you have to deal with, and you've got rules on how to manage it. But as it pulled back like that, and notice, I don't know if you can see my pointer here, but let's say where it says 5-minute trend right above the T, where it breaks out to a new high in the day and it comes right back in again. That's not what you want to see. It creates an uncertainty and brings in sellers, but it doesn't violate the trend. So at that point, once this started going sideways through lunch, what that communicates is that buyers are continuing to step up. There's strong demand. And if there's a void to the left, it supports a bias that prices will continue to go higher. And as you can see, you've got multiple trends in alignment there. You know, the 15-minute chart, the 60-minute time frame, and the 5. They're all in alignment to move higher. And I can see that on one time frame without looking at the others. So here is TC2000. It's a popular software. Scans real fast, easy to put scans together. And for students that purchase my GAP course, which goes into great detail of what I've explained to you here, I give this away. So if you thought this was a pitch coming to buy it, it's not. If you buy the course, you email me through the software, which is called TC Mail, and I send you a file, you click on it, and this opens up with all of the scans and charts right on your platform. So what I'm looking for here is stocks that are gapping up a certain percentage, and it's sorted, and then I want to see, did it gap above the high of a bar? Is it gapping, bullish gaps? Are they gapping above a red bar? Is it currently trading above the opening price in yesterday's close? And that chart that we just looked at, the ABBV, was right at the top of the list yesterday, gapped up 5.33%. And that starts the process. And what I like about the method that I've explained to you is, for myself, I don't feel pressured to act in the moment because it's a 5-minute chart. There's a choice as to the time frame that you're going to use, and it's not a right or wrong. It's what fits your personality and where your comfort zone is. And I'm comfortable on the 5-minute chart. The 1-minute chart, I feel like I have to act now or I'm going to miss the trade. And not that you can't get a setup on the 1 minute on the ideal scenario. But I'd rather just wait for the 5 to set up, because as I put these multiple pieces of the puzzle together, the odds are in my favor that it's going to continue. And I'm then looking for pictures. And then you see the 5-minute chart on the bottom there with the mini shocks. That's a beautiful pattern. It tried to go down 2 times. And even if I bought above the high of the first 5-minute bar, which would have been fine, I'm going to share size it to give it room. So that second bottoming tail bar is just okay. And it actually makes it an even better trade. So you look at the percentage of the gap. What did it gap above? This one gapped above the high of a red bar. Is it a wide range bar? No, it's not. But it's trending up and it's gapping above a correction bar, the red daily bar. I look at the market. Is it showing relative strength or is it showing relative weakness? And you put all of this together, puts the odds in your favor, so that the now, the symbol now there, was in the scan that looks for gaps above a red bar. And so it gapped up just over 1% above the high of a red bar. So, and it was gapping above the high. So it was in that scan. You don't get a lot of stocks in those yellow boxes there, but when they're there, you want to pay attention. There's a shock element to it, and it's gapping how much you want. The blue one is lower price stocks that are gapping up. Sometimes you find great things in there, and of course ones that are gapping down. So as I said, I've been doing this for a really long time, trained tens of thousands of traders. These are some, testimonials of traders that have emailed me, and I've got, thousands of them. Traders that had light bulb moments and how to put this all together, because education is about cutting down the learning curve. That's what we all want. And I wish there was good education when I started, because it took a long time of searching and, of course, putting it together. And part of the process is, finding what works for you. I know what works for me. Now, the class, you can go to the website, and that's the page, mastertrader.com/gap trader, and you could look at what's here, and there's some other information. I sell this class every day for $795, and being invited here to speak to everyone. And of course, I made a special price for everyone. And if you enter that code, TTMTSGAP, at checkout, it'll reduce the price to $495. And you get access to the course, view it as much as you like, and you're welcome to email me with questions afterwards. And I've got so many students that email me and say, Greg, what do you think of this setup? Or what do you think of this one in multiple time frames? You know, after they took the trade, of course. But, you know, I'm here to support after you take the course. That's what I've been doing for over 20 years. So if there's any questions, you're welcome to put them out there, or looking back at anything else. And you know, if you take the course, I mean, it's about trading for a living, and this puts that together for you. I can't see the questions if there are any, but okay.
Greg, can you see the questions?
No, I cannot.
Okay, all right. You should
Wait,
be able to see them.
maybe I can. Maybe there's a breakout here.
Yeah, there's a little breakout on the dashboard. The little
yeah.
It says questions. You pop it out. You'll just have to
Oh, sorry.
It might put you at the top.
All right, so let me go through it here quickly. We have good morning, good sound, good sound.
Yeah, go down to about 11 or maybe Eastern. What time zone are you in?
Yeah, I'm going through it quick.
Okay. For me, it's Central Time.
All right.
About 11:10 or 11:15 Central. Or you can just scroll to the very bottom and then work your way back.
Yeah, Steve, sound. You're talking about common consolidation zones before. Yeah, I mean, consolidation zone, call them whatever you want. It's a base, right? Give us names of banks using. Oh, that's not for me.
What time stamp are you
Do
looking
they work
at?
in lower time frames? You put it, I think that was also about the market profile.
Yeah, so he went after you. So around 11:15 Central, whatever time that is on your time stamp.
Okay, so that's 12 o'clock.
That's
Guys,
what it's
remember, when we talk about time frames, they're a choice, and things move around when you change the time frames. So what looks great on a 1-minute chart could look like garbage on a 15-minute chart. You start with the higher, you can work lower from there. But you realize, you know, whatever your method is, whether it's pictures or indicators, things change as you change time frames. Multiple time frame alignment is the key. All right.
I can help you with the questions if you want. I can see them.
Yeah. Trade. Oh, idea. Look at the one at 1222. Somebody there kind of joking, Jeanette. I won't even repeat it. What does the tail on a bar mean? A tail means that it went, if it's a bottoming tail, it means that it went down, buyers stepped up, and prices retraced all the way back up again. So it tells you that there is demand and buyers took control. Are we going to get a video of the recordings? And that would be able to answer that. Are they simple or exponential? They're simple. If you like exponential, nothing wrong with that, Wayne. Right? There's no magic to them. I like simple. The day before you wanted to follow it because it was breaking out of a sideways consolidation. I don't know which slide that was, TP, but very possibly yes. You know, if it was going sideways. Remember, a lot of what will come in the scan, I will not even be aware of it the day before. It's because it's gapping up or down, the scan brings it to my attention. In the upper chart suggests sellers are in control since there's a topping tail. If there's a large tail on the top, it absolutely means that sellers took control within that time frame. Can you talk a bit about the run on stops where algos and others know where stops congregate? You know, Michael, this whole idea of running stops has been around forever. You know, today it's algos. Years ago, it was market makers. Use it to your advantage. Like I showed you bottoming tail candles that broke down under areas of support. Like, use it to your advantage. That isn't to say that sometimes you won't get stopped out. I'll give you an example of getting stopped out, ripped right back up again, and took advantage of it. Look at Bristol Myers. Nasty break to the downside on the daily chart, rips right back up again. When you see that, whether it's an algo shaking the tree, whatever they did, the big money stepped up and they just absorbed it and ripped it right back higher again. Use it to your advantage. Do you treat gaps due to earnings reports differently? It depends. No. Earnings season, it makes it even better because you get more gaps. Intel, fantastic. Look at my video on YouTube from yesterday talking about Intel, and I'll go through the multiple time frames there. Gap and go. I don't know which one it was, Eddie. I'm sorry, I wasn't watching the questions at the time. You adding shares during lunch? Absolutely. I have a whole course on position and money management at the site. Advanced management strategies teach you how to add to positions, how to take your profits and add to your position and keeping your risk the same. It's amazing. What powers the TC2000 scanner? Their servers. It's fast. It's amazingly fast, and you know, doesn't have the prettiest charts, that's for sure, but it works well. Right. Somebody says, I love what I hear. Awesome. Can you speak about professional gap? Professional gaps, TA, are gaps that happen after a correction. In other words, or it's a gap that makes sense, if you will. Whereas, you know, say the market goes up for another 2 days from where it is, and it's like, oh my God, you know, it's kind of ridiculous already. And then it gaps. The Dow gaps up 200 points. That's a novice gap. I'm going to look to fade it. Great teaching. Awesome. Is it going to be recording? Jeanette will answer that. Tail on the bar. Great webinar, Greg. Do we have a trading room? I don't today, Bob. I'm considering doing it. You know, I did that for a lot of years. You know, I had guys running the trading room for years. I'm kind of on the fence as to whether I want to get back into that or not. You know, what we do now with our trades, we do a lot of options trading with our advisory letter. We send out text alerts so you get updates instantaneously as to what we're doing, entering or exiting. MA equivalent 520, 60 minute. Is this correct? It's exactly how I calculated it, how I showed you. Can you talk about the run on stops? Oh, I think I got that. Someone else, I guess, repeated it. How do you avoid being a victim? Don't act like a victim. You know, brush yourself off. You get shaken out. It happens. Use it to your advantage. How often can you retake, or is the training available ongoing? I provide access to this course for 90 days. If you wanted extra time after that, I'd be happy to provide it. So when you sign up for the course, you'll instantaneously get access for 90 days. You can watch it to your heart's content. Choice of trading platform besides TC, I use eSignal. Chat room, I answered. Is this program for daytime working adults? No, it's for those that want to trade for income. I have other education for those that are working, you know, option trading, swing trading. You know, this presentation was specifically for gap trading in the morning. The scans that I've written are just for TC, and they're not complicated at all. If you want to email me, I'm happy to give you the criteria. It's nothing that's proprietary. you know, for me, it's just what I explained, common sense. I put it together there. It works. I'm sure you could write it in e-signal. I'm not sure about that. Probably TradeStation or what have you. But if you contact me through TC2000 after you buy the course, I'm happy to send this to you. You open up the page. It'll open up with everything done. Do you have TC2000 subscription to get the professional gap list? Well, you have to have the platform, of course, TA. So you have to pay them. I get nothing if you subscribe to TC. I just provide that page with all the scans connected to it as part of the course. Part of the swing trade, high frequency trading? Not at all. Difficulty in swing trading comes with choppy markets, and this market is not choppy. The downside of this market is it doesn't pull back. So you know, a lot of times it's necessary to use intraday charts to enter. Would you repeat how to calculate? I'll just go back to the slide. You can capture it. There you go. That shows you how to do it. So you can do that with any time frames and any moving averages. You can do that. YouTube.com/C/Master Trader Z. I would assume you could look for Master Trader as well. The gaps will stop swing trades out more often than before. I don't know that it happened any more often than it happened 15 years ago. You know, gaps happened 15 years ago, especially at earnings time. So, you know, gaps happen more. You have more people trading. You have more sophisticated technology and such. So things just happen a lot faster. You know, years ago, it was easier to trade from a 1-minute chart. Today, you know, if you did that, you know, all the time, you're probably gonna, the expression, you know, a death of 1,000 razor cuts. What's your risk to reward ratio? If there's a void, your risk to reward, you could say a minimum of 3-to-1, but it's about money management. I look at the chart and I look at where my stop is and my entry is, and I calculate my share size based on how much I'm willing to lose. And from there, it's about management. Okay, you bought the course, awesome. Use many times. You can view it 1,000,000 times as you want. Is the 240-minute, 4-hour trend line? It's not a trend line. The 240, I used the 200. What I said was the 240-minute moving average was the 20 MA on the 5-minute chart. And I said the 200 is close enough. You know what, guys? For those of you that are in here that are asking about lifetime and you want to have it for life, because you're here today, and Jeanette, you can put that in there, take note. Anybody that buys the course today, I give lifetime access to it. Okay. My email is greg@mastertrader.com. When you sign up, it's going to say 90 days. If you buy the course today, you'll have lifetime access. Watch it as much as you want for the rest of your life. All right, guys. Thank you for coming. It was a great session here Saturday, spending with you. And
Greg, put the link back up for me one more time, and I'm going to post it with the lifetime access.
What do you want me to do, Jeanette?
Post the link that they go to. Put that slide back up. It's Master Trader.
They just go to mastertrader.com / what did I make it? Gap Trader?
I don't remember. I think Gap Trader. I think that's right.
I'll put it up on the slide. Yeah. So when you get to the page and you scroll down to buy the course, it's going to say $7.95. When you enter the
coupon or
the code there, TTM MTS Gap, it's going to change the price to $495.
Discount. Okay, got it.
All right. And so when you get the access and you go into your members area, It's going to say 90 days, but I'll know because of the code, and I will increase it to lifetime. All right, guys. Is there a return policy of 30 days? Absolutely not. And I can't even imagine why you would even think about it. After you watch this for 30 days, and even before that, you should be making money. You should be offering more money to me to say thank you very much. I'm kind of being funny here, but believe me, anything that I put out there is top notch.
So I think I get you. Yeah. I mean, you know, when people want the money back, it's like, well, I gave you access to it and you watched it all, and now you want your money back.
Right. It's like,
well, you know, should have thought that out, you know.
I've eaten the steak, but no, I get my money back.
My wife said no, she changed her mind.
Right. All right, guys, everybody have a great weekend, and start learning. If you have questions, Greg@mastertrader.com. All the best.
Thank you, Greg. Thank you so much. Have a great weekend.